got that G, got my nullos. I'm just saying. We pull up to the scene, they be filled with jealousy. If a bitch get
stop
finicky, she gon' bring the energy. I hit a phone with a
3, 2, 1, action.
Dear light. Treat me like a treat
So hello everyone, it's Video and I'm back for another video, and I hope you guys are having a good time. Welcome to my channel. How are you guys doing? Let me know in the comments below. Okay, so guys, you have seen the title of this video today. It's called what is a reverse stock split or a stock split. So there are two occasions that I'll be explaining in this video for you guys, okay, especially for beginners. So now we have something in the stock market where NASDAQ gives you a compliance requirement. One of those requirements is for a company that is listed in the NASDAQ or in the stock market to have up to $1 as a stock price. The cost price of a stock should be up to $1 in order for it to be listed in the stock market, okay? So when a company falls below the requirement, which is $1, after a long time of being listed under the $1 bidding price, which is the basic requirement, NASDAQ always gives a company up to 180 days, which is about 6 months, for them to get back to the bidding requirement to be listed in the NASDAQ or in the stock market, okay? Now, if that does not go through, so now when you have, first they'll give you, you know, a number of time, like a long time, and after that they're like, okay, after we are giving you 100, we'll give you a compliance notice. If your stock does not get up to $1 back to the basic requirements, then we'll have to delist you from the stock market or from the NASDAQ exchange. So when this happens for NASDAQ gives you 180 days as a company. There are many ways you can get back to $1. One of them is, let's say the CEO decides to buy more shares, which now makes other insiders buying, or investors now believe in the stock and they start buying, which means the higher the demand, the higher the supply, right? Then the price can get back to $1. Now if that does not happen and they decide to go with the safer route, what happens is that they do what we call stock reverse split. This is when, if you have, let's say, 1,000 shares of a company or 10,000 shares of a company, and now they do what they call a reverse split, what happens is that your 10, they may say 10 to 1 or 35 to 1 or 3 to 1. That means they are now changing. They will consider each of your shares as one single share, then they'll merge it from three shares now becomes one.
Oh, damn. I'm sorry.
So let's say the stock is about 50 cents. Now 3 shares, 50, making it one, now becomes $1.50. So automatically, if you had 3,000 shares, your shares now at the end of the process, the action of a reverse split, your shares, if it's 3 to 1, your 3,000 shares now becomes 1,000 shares. You see? So what they do is called, I'll say, merging of the shares. You know how white light goes through a prism and it separates. Now those separated color spectrums are individual shares. Now when they go through a black object, what happens? Absorbs into one.
We always got to come with the receipt,
right? Because black objects absorbs, white objects reflects. So if you're using the idea of the prism, triangular prism, reflection and deflection of white light, reflecting goes to the ROYGBIV. Now when it goes to a black object, it absorbs into one solid form, okay? So that's what happens. So I would also say it's another form of merging stocks, shares into one whole share. Okay, that's when a reverse split occurs. That's what happens. Your shares are now becoming smaller but higher value in order for them to still be in the stock market to avoid being delisted. Now, as a beginner in the stock market, I will advise you, whenever you hear the rumor of a reverse split of a stock, I would advise you run the other way. Find a way to average down, dollar cost average, get your stocks out and run. Don't wait for the stock to go through a reverse split, except you are interested in that stock and you would stay with it long term. Then I would say, okay, after the reverse split has occurred, if you had 1,000 shares and they did a 3-to-1, then you have about 300 shares, or sometimes they do ZSAN just did 35-to-1. So you can imagine, so if you had, like me, if you have 1,000 shares divided by 35, honey, that is a lot of, so your shares now become smaller but with a higher value, and that can attract some unique investors, like, oh, okay, I love this stock price, without, you know, I think I can invest in this stock. So sometimes it attracts new buyers, but I would suggest run the other way if you've been in it already, or sell as quick as you can, take your little loss and run away. Do not wait except you are interested in this stock, okay? Please, I'm begging you. I have gone through that about 3, 4, 5 times. It's awful, those losses, so I don't want you to go through that, okay?
This ain't no allegedly.
Treat me like a treat me.
And if you go through the reverse split and you would like to stay with the company, I'll suggest staying after a month before averaging down. Do not dollar cost average right after the split, because sometimes that stock keeps going down. It just keeps, yeah, slowly. It's like a melting ice. You don't want that. You don't want that time decay of your stock, okay? So that's what happens when a reverse stock split occurs. If you had 1,000 shares, it becomes 100 shares if they do a 10-to-1, okay? So that's the safest way to explain it for you guys that are beginners.
But I'm not like anyone.
Y'all heard it, right?
Feeling like a psycho freak sometimes.
Now, when it comes to a stock split is, for example, we have Apple. Now we have the white light going through a triangular prism. It now disperses into different color spectrums, the ROYGBIV. Now that is what we call a stock split. Then in situations where this is really used is when a stock has grown exponentially cost value wise. It's so huge that it's no longer attracting, the company is no longer attracting new investors that cannot afford those prices. Like Tesla was $350, now it's about $1,000. What?
Oh, damn.
Tesla may decide, okay, if we want more investors to invest with us, we'll do a 1-to-4 or a 1-to-3 stock split. Remember, when you're doing the reverse stock split, that's when the stock is not up to $1, so you try to the minimum bidding. Now when it comes to the stock split, it's the opposite. When the stock has grown so exponentially that they need new investors to come towards them and invest more, you know, they want more investors in their company, then they can do a stock split. Tesla may decide, okay, let's go with a stock split. Now they can say, okay, if you had one share at $1,000, now that stock, if they do 1-to-3 or 1-to-5, that stock of $1,000 will now be split into 5. So rather than having just one stock at that price, you're now having 5 shares at that price, okay, which is better. You're having more shares of the company. That's a good one. You see, that's the type of split you want.
Amen.
This is what this is.
Now, for example, we have Amazon. Amazon is over $3,000 a share. Amazon may decide to do 1-to-20. So when that happens, you still have your value, you still have your money, your money still stays, okay? That value still remains. But now they may say 1-to-20. So now $3,000, which is for one stock. Now that one stock now becomes 20. One share becomes 20 shares of that company. So you're now having more at the price of the one you had. So with that, when the price at that point, the price may now be lower because they've now splitted that one money into 20 parts, which all still has the same amount of strength as your one share you once had, but now you're having 20 shares of that company, so you're having more for the price of one that you had. It's like having a 20-to-1 deal, or you know what I mean, 20-to-1 deal now. Okay, so if you had 5 shares of Amazon at 3,000, you will now have times 20 will now give you 100 shares of Amazon, which is great. Okay,
I got chills, then multiply.
but this is the part. When that happens, new investors now cannot afford the new price. Let me say, if it was 3,000 divided by 20, right? Whatever that value is, now that will be the individual new shares. That will be the new price for each of the shares. Or let's say it was $22,000, now divided by 10. Okay, now you now have that price for each of them. Divided by 10 should be 200, right, if I'm not mistaken. Yeah, 200. So now each of your shares will now be $200 per share. So at that price, people like me or someone else cannot afford $200 for a share. So it doesn't affect you who bought at 3,000, because you now have more shares. But this person now coming in is like, oh, these shares are now 200, I can afford it. You know, I can try and afford this. So they, when they buy, they get one for $200, right? But you had your 3,000, now that gives you 3,000, and you sometimes they give you an extra fractional shares, like thank you for being with us all this while. So you may even have more for you that bought at a higher price. So I hope this helps you. I hope this helps you understand the difference between a reverse stock split and a stock split. A stock split gives you more shares. A reverse split gives you lesser shares in order for the company to avoid being delisted and still maintain their status and their place in the Nasdaq and in the stock market, to avoid being delisted. Okay, so these are the safest and easiest way to explain reverse stock split and a stock split. Reverse stock split, when the white light goes through a dark surface, and a stock split is when the white light goes through a triangular prism and it then disperses into many other forms of dark light. Okay, I can't wait to see you guys soon in the next video, and I hope this helps you as a beginner enjoy the stock market, because I went through a lot of stuff. No one taught me. I'm still on my way, learning as I go, so I'm sharing it with you guys so that way it's easier for you guys, because I lost a lot learning to the point now that I know what I'm doing very well. So I am sharing this knowledge with you so that you guys can learn from my mistakes and do better. I'll see you in the next video. Okay, so a reverse stock split is when you try to make the $1 minimum Nasdaq requirement. Your stock, if you had 1,000 and they say 3-to-1, it's now like 300 left. Or if they do 35-to-1, that means your 35, each 35 stocks shares you have now becomes one share, one whole share. So you're molding a big tree.
The is getting hot in this sweater dress. Let me turn on the fan real.
But when it comes to a stock split, a big tree is now being divided into different versions, which can now help new investors to be attracted to that company and are able to get, because sometimes they've been waiting for the opportunity to join that company, but they couldn't because of the price. So when big companies do stock splits, the people who have shares will have more, and then new investors like us can also be able to nibble at the new prices because it's more affordable to us. Okay, I'll see you guys soon in the next video. From Salvador and DAWSON. Bye guys.
Cause I'm loving myself real good.
Did you guys hear that? I'm scared.
In a way that you never could.